All right, so what do we want to do? Well, when it comes to proper wave use, you must do two things. One, you must have the proper market memory. I'm going to list it right now, go through each time frame. We're going to go through this quickly. Again, we covered this last week. I just want to have a quick review here today, okay? So, 15-minute chart. To get the right angle of the wave on your chart, it is absolutely important that you make sure you're looking at the 15 with at least 3 days to about 5 on the screen. In other words, that's the amount of data that you want so that you can make sure you're, number one, seeing the appropriate amount of data to make decisions about drawing trend lines, maybe drawing a Fibonacci retracement. But most importantly, what I'm hoping that you'll see is the relevant price action. That's what a market memory is. And for a 15-minute chart, it's 3 to 5 days. So you can see here, I'm basically looking at February 23rd to 22nd. That's not quite enough. So I'm going to squeeze in a little bit more. And you'll see now I'm looking at basically the 23rd to the 18th. So I'm looking at 5 days there. That's the upper end of what I'm comfortable with as far as relevant price data on the 15-minute chart. Okay? So that is what we want to make sure that we see when we're looking at the look back, the market memory, and taking a wave reading, what we call a clock angle reading, on the 15-minute chart. On the 30-minute chart, it should be 1 week. And if you notice here, I've got February 11th to February 23rd. Now, it's a little bit more than I need. A 30-minute chart, I can go all the way out to 2 weeks, but I can also go about 1 week. Now, these aren't fixed levels because I realize that these calendar axes don't slide to let you go day by day. You're going to sometimes jump depending upon the price range within this time that you're looking at. So realize you want to get close. More is not better. Less is not better. You want to get close. But if you have to err on one side or the other when you're trying to squeeze in the appropriate amount of data, go ahead and err with more. So I'd rather you get a little bit more data than less. So 30-minute chart is basically 1 to 2 weeks. The 1 hour chart, you need 2 weeks, okay? If it edges closer to 3, that's fine, but you need 2 weeks, okay? So again, here I've got 5 days. Actually, no, I've got 11 days. That's not quite enough. Not bad, but it's not quite enough. If I squeeze a little bit more in, you see it jumps almost to 3 weeks. All right? I'd rather you err on the side of 3 weeks then. Okay? The 4-hour chart, you're going to be somewhere between 4 to 6 weeks. So a month to about a month and a half. Here we have January 12th to February 21st. That's about 6 weeks, and that is absolutely fine. Again, what are we doing from this view? Okay? What are we doing from this view? We're basically taking a reading on the relevant highs and lows, the overall trend, last major moves that we might do Fibonacci retracements off of, and we're taking a reading of the angle of the wave. Again, quick recap of what we talked about last week. Finally, the daily chart. Daily chart needs 1 year, okay? 52-week highs and lows are important to a daily chart. Now, if you end up with, say, 14 months in that quest for 1 year, that's fine because I need you to see the last year's rally, the last year's worth of rallies and sell-offs, what the overall direction was, the highs and the lows. Those are all relevant, so about 1 year. Now, once you're done with taking the reading of the wave, the angle of the wave, the clock angles that we talked about last week, once you've seen the relevant highs and lows and the last major move, feel free at that point to go ahead and expand out. You don't have to stay within that market memory reading the entire time you're analyzing the chart, especially if you like candlestick patterns and things of that nature. You probably want to zoom in a little bit. But let the first view of that time frame be within the market memory, again, to get all those relevant points recognized on the chart, and then also to make sure that you're taking the right clock angle of the wave. Now, that is particularly important for what we're going to talk about here today, because if you don't get the market cycles right, if you can't recognize the 12 to 2, 3 o'clock, 4 to 6, or 2 to 4 angle of the wave, you're going to be basically starting off on the wrong foot because the market cycle dictates what type of setup, trending versus non-trending. So it's absolutely imperative that you start off with this view and take a market cycle reading. Now, the Euro-US dollar daily, absolutely, 4 to 6 o'clock markdown cycle. This is a trending market. We're going to use trending setups. We're going to use trending patterns. Okay? Okay, so if I were to contrast that with a 15-minute chart, this was in a downtrend today. It's trying to transition into a little bit more of a potential sideways market, so keep an eye on that. This could be transitioning on to a sideways market. Again, this is a 15-minute chart. You must take a market cycle reading of each individual time frame. This is not something we simply look at the daily and say the Euro-US dollar is in a downtrend. Overall, yes, overall assessments are taken by the daily, but there are opportunities to buy in a downtrend. There are opportunities to play breakouts and breakdowns in a downtrend, but those are likely to happen on shorter time frames. So if the overall trend on that daily is down, that's fine, but that does not mean there aren't opportunities to do things other than short the market if you're looking at the smaller time frames. Okay? All right. So as we take a look at what we're looking at here on this chart, and we want to go ahead and get into the second stage of what we wanted to talk about here today, which is reviewing trending and non-trending chart patterns.